Morning from Sanaka Global Trading here in London. A quick word to the weather forecaster on the BBC over the weekend. You're an idiot. You were forecasting sun with the occasional shower. It is foggy and pouring down, so I suggest you change jobs. But there you go. Now, on the markets, doing a quick run through today before everybody gets in London on the equities side. We know you guys work leisurely gentlemen's hours, so we will make it quick so you can have your scones. Now, on the euro dollar, as you see, it is slightly bid over the weekend, overnight in Tokyo, trading currently about the mid 130s. The next resistance level, we'll stick this in, is, well, there, about 70 points higher. That's quite a strong resistance. You can see it's basically double. Now, the reason for this bid basis is the widespread misunderstanding that the Eurozone banking deal that was announced on Friday is actually a deal. It is not a deal. It is absolutely no different to the deal that was outlined in June. In fact, it's actually worse. There is going to be no retrospective accounting for the bad loans at Spanish banks. That was in the original deal, so it's actually much worse. All it's done is it's pushed the basic decision now to the tail end of next year, which happens to coincide handily with the Bundestag election. So Angela Merkel can push that to the back burner. Now, we're going to have a look at in sum, on the euro, people's capacity to delude themselves continues to burn bright. So we are not calling this. We are naturally, from our own perspective, we are naturally bearish the euro. But if people take non-deals as being deals, who knows, frankly, where it's going. The Aussie dollar we're looking at next. We'll look at it against the US dollar. Here, these charts are brought to us by our friends at Finbird, of course. Now, the Aussie dollar, there is nothing really wrong with the Australian economy. Okay, growth in China is slowing down, and that's one of Australia's biggest export markets. But the fact is, there's really nothing wrong, certainly not on a biblical scale of the Eurozone. However, the central bank has taken it upon themselves, under political pressure from Julia Gillard, who faces an election next year, which she at the moment is not looking likely to win. The Australians do not like seeing deficits. They've had a few in a row now, budget deficits that is. They've had a few in a row, so they don't want another one. So what they've actually announced is that they are going to cut spending. Wayne Swan, the Australian Treasurer, announced this overnight. They're going to be cuts in healthcare spending and family support payments to help deliver this election year budget surplus. That will in turn give the central bank scope to further reduce interest rates, and thus the idea is that it is good for economic growth. So Australia's target now is for a cash surplus of 1.08 billion Aus dollars. That's about 1.1 billion US dollars in the 12 months ending 30th of June, compared to a previous Aus surplus of 1.54 billion in May, and spending is forecast to be 363.2 billion Aus in the same period, compared with a May projection of 364.2 billion Aus. What does this mean for the Aus? Frankly, not a great deal. The Aus is trading as it always does, in its own inimitable fashion. You have the high levels around here, the base around here, and all you simply do is just trade the range. As you can see at the moment, it's stuck right in the middle. Against the Canada is a different kettle of fish, because the Canada is essentially an all trade at the moment, but we'll have a look at that fairly shortly. Now we are going to look at the yen. The yen had terrible export figures over the weekend. They fell 10%. Which in September, which is or 10.3 to be accurate, from a year earlier, to leave a trade deficit of 558.6 billion yen. That's the most since the immediate aftermath of last year's earthquake. And prior to that, as you know, we had the terrible Tankan survey, and we had all sorts of hideous other figures. GDP growth was running at that annualized 0.7% in the second quarter after a 5.3% expansion in the first. Let's have a look at the yen chart here. As you know, the yen, basically the Bank of Japan wants the yen much weaker. It didn't have a great deal of luck on doing that, but it has had some luck recently, aided and abetted obviously by the bad economic figures. Yen's currently hovering, as we see, below the 80 level on the US dollar. So that is toppish. If you look back a little bit, say to say 6 months. All right, we'll go to a year then, if we don't have 6 months. As you can see, it's about roughly where the resistance level is there, which is, as you would expect, it's protecting stops above the 80 level, and then there's another resistance there and there. Natural inclination is to, on an economic basis, is to sell the yen, which of course is what the Bank of Japan wants, because it's caught in a trap at the moment of a strong yen affecting exports, as we've just mentioned on the export figure. Looking further ahead, Japanese Economy Minister Saiji Mahara said that the country needs more monetary easing and policy efforts to encourage growth. That is true, certainly does. It can't actually do that though, because it hasn't got any money, which is a slight problem. But I'm sure Prime Minister Yoshihiko Noda, as he prepares for an election against the opposition, which is doing quite well in the polls, that is the opposition, not Noda, he's going to do something about that. Right, I reckon that's about it from us this morning. Have a good day, and I'll speak to you later.